This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, after what probably seems like a lifetime studying income tax, you'll be very relieved to hear that now we turn our attention to national insurance and national insurance contributions. Now, this is another taxation that is levied on income, but it's very specific to workers and employers. Indeed, it was originally created, national insurance, to be paid by workers and employers to fund various state benefits. Long gone, of course, since then. It now goes into the general coffers of the government for them to spend on whatever they deem fit. But what we've got to know is who pays national insurance contributions and what types of national insurance contribution and how do we calculate them. Now, the first category of people that we need to see in terms of workers is employed earners. Now, so far as people in employment are concerned, both an employee and an employer may be required to pay national insurance contributions in relation to their salary or wage. What we'll then move our attention to is the self-employed. They too are workers and they too will be charged to national insurance, and national insurance contributions will be required. Now, the categories of national insurance contribution, they're called classes. The first one relevant for employed earners, and the only one relevant for employed earners, Class 1 contributions. Now, Class 1 NIC is paid by both employers and employees. Employees and employers. So far as the employee is concerned, the contribution will only begin when the employee is age 16 or over. So far as the 2016-17 tax year is concerned, the main rate of employee Class 1 NIC is at 12%. I say the main rate. It would be worthwhile, as ever, of course, when we go through these chapters, for you to have open the relevant pages of the rates and allowances pages there. Here, quite an extensive one, dealing with national insurance contributions. And you will look at Class 1. You will see employee, Class 1 employee contributions, sometimes referred to as Class 1 primary contributions. These are the ones paid by employees. Now, I say sometimes paid. They are only paid in relation to cash earnings, your salary, wage, bonus, commission. They're not payable on assessable benefits there. We will see that there is a national insurance contribution to be levied in relation to those assessable benefits that we saw back in Chapter 9, but it's not Class 1 and it's not paid by employees. So, cash earnings on an annual basis for our 16-17 tax year, they only become payable if you exceed a threshold of £8,060 per annum. So if we go over £8,060 per annum, then the rate is 12% on this amount above 8,060. But it doesn't stay at 12%, we'll be much relieved to hear, because that only goes up to an upper limit. Now again, on your rates and allowances page, for Class 1 employee contributions, you should be able to see the both the lower and upper limit, the threshold and upper limit, 8,060 and £43,000 respectively, and that between 8,060 and 43,000, the tax rate paid is 12%. If you've got, again, employment income in excess of 43,000 per annum, then on that excess, the rate falls to 2% with no upper limit. 2% on the excess above £43,000. Contributions will then cease when the employee reaches pensionable age. So far as employers are concerned, they also have a lower threshold below which NICs are not payable, and that slightly higher than the employee at £8,112. Again, it is on the same cash earnings that we're talking in terms of. But now a couple of important differences. One, the rate is higher. That is 13.8%. Again, find it on your rates and allowances page there. It too becomes payable for employees from their 16th birthday, but there's no upper age limit, and rather more importantly, there's no upper limit in relation to the 13.8%. So as soon as you exceed the threshold of £8,112, no matter how high it then goes, may go well above 43,000, that upper limit so far as the employee is concerned, it's 13.8% on anything above or from £8,112. We mentioned there that that is on cash earnings. There are then Class 1A contributions, as you see here in section 1.2. This is only payable by employers, and it's on taxable benefits provided to the employees. It's the self-same rate as you use for the employers NIC, the Class 1 employers NIC, 13.8% there, again multiplied by, of course, the value of those assessable benefits. So, Class 1 contributions payable by both employee and employers. In both cases, there is a lower limit below which nothing is paid. Above that limit, but only on the excess above that limit, do we then pay at the main rate for the employee, 12%. For the employer, there is a single rate of 13.8% that will apply on everything above £8,112. So far as the employee is concerned, above £8,060, 12% goes up to £43,000 per annum. Above that, a welcome reduction, it is only 2% thereafter. Class 1A contributions, only payable by employers, on just the taxable benefits, and again a standard single rate of 13.8%. Now, something that has come in recent years, Her Majesty's Revenue and Customs, God bless them, HMRC, introduced an annual employment allowance. Now that for our 2016-17 tax year is £3,000 per employer. This is not per employee, this is for the business, per employer, to reduce employers' Class 1 NIC payable. The whole idea of this, often again, sometimes rather emotionally referred to as this tax as a tax on employment there. But the idea was, by giving this employment allowance, hopefully employers might employ more people, and that can only be a good thing so far as the economy and thus the government are concerned. But how do we deal with it? If the employer's Class 1 NIC for the tax year is £5,000, we simply reduce it by £3,000 and will therefore pay £2,000. Now, it is a reduction. It can only reduce down the employer's Class 1 NIC to zero. So if the total NIC was £2,500, it's just nil, therefore that would be paid. We've then got to be a little bit careful about companies, that quite often individuals will incorporate their trade, and they are literally, as we know it, a one-man band. They are a single individual company. Him or her, they are the owner, and they are the director, they are the only employee. Now, that is the case, then the employment allowance does not apply. It is no longer available. That wording, therefore, meaning that it used to be, but not now. No longer available to companies where a director is the sole employee. Now, it's, I guess, a logical move, because the whole point of the employment allowance was for businesses to support employment, to actually employ more people. If the only person that your company employs is you, then no, you don't get that employment allowance there. The non-availability of that employment allowance, so far as those owner-managed companies, the single owner-managed companies are concerned, will be relevant in certain tax planning scenarios, which we review again in Chapter 26. For example, when you decide to trade, you have a choice. You have to decide between the unincorporated route, so whether to go as a sole trader, or whether you should incorporate the business. So do you set up the business as sole trader, unincorporated trade, or incorporated trade? And if you do go down the incorporated route, how then do you extract from the company the profits? How are you going to pay yourself? How are we going to classify the money that you take out of the business? when you take money out of the company as an owner-manager of a company, any monies that you take out, there are no things here like drawings. What you can do is to either pay yourself as an employee, you are no doubt the managing director of the company, and therefore you can pay yourself a salary. So it's either director's remuneration or dividends. So two main methods of profit extraction, if you want the cash in your pocket, that is. In your capacity as manager, you pay yourself a salary. In your capacity as owner, you pay yourself a dividend. Now, there are important tax differences in terms of what those and how those impact. For example, if you are paying yourself as the managing director a salary, salaries are tax-deductible expenses for the company, so they'll be deducted in deriving what we'll come to know in our corporate tax studies as the taxable total profit of the company. They are tax-deductible expenses, reducing the profits of the company. But of course those salaries will then be chargeable to, in the hands of the employee, the individual, both income tax and national insurance contributions, depending of course on how much salary that you pay yourself. If you, as the director employee of your company, restricted your salary for the year to say £8,000, then we've just seen that 8,000 is below the NIC threshold for either employee or employer's national insurance contributions. So there'll be no NIC to pay. And at £8,000, that of course would be covered by your personal allowance, so there'd be no income tax under the pay-as-you-earn system to pay on that salary either. Over and above that, you could take money out in the form of dividends. Now think about the tax treatment of those. For the company, do you think that a dividend is an expense that is deductible in deriving the taxable profit of the company? Now I know you haven't studied corporate tax, but I'd hope simply from your accounting knowledge that you would know that that is not the case. Dividends are not expenses to be deducted in deriving a profit that will then be subject to tax. Dividends are distributions made out of the taxed profits of the company. So a dividend payment achieves no tax relief for the company. It's not an expense, it is a distribution. But that dividend, of course, is taxable in the hands of the individual shareholder, the owner-manager of the company. And what you've got to be able to do, of course, is to establish what would be the tax upon that dividend. Now, we know how dividends are taxed. We have a £5,000 nil rate band available in relation to our dividends there. We also know what the special rates are. If you then have dividend income above 5,000, that falls into either the basic rate, the higher rate, or the additional rate band. So in Chapter 26, we explore those issues about deciding between unincorporated and incorporated trade, and the sort of calculations that you may be required to prepare. There'd be nothing drastic there. You would be led through such a question at this level. And if you go down the incorporated route, what are the tax implications in terms of paying yourself a salary, as we have just defined, tax deductible for the company, but chargeable to both income tax and NIC in relation to the individual. Whereas, if you pay yourself a dividend as the owner-manager of the company, not tax deductible for the company, there'll be no corporate tax saving there, they are distributions. But in the hands of the individual it will be taxed, not immediately. The first £5,000 of dividend income, as we know, is free of any tax. We've got our 5,000 dividend income nil rate band. Above that, then it depends, are you basic, are you higher, or are you additional rate? Okay, so there, that issue about the employment allowance not being available to one person company rather than one man companies there, my apologies. That's employment allowance not available, but it begs a bigger question, and it as a single issue will be brought into dealing with those decisions between unincorporated and incorporated and of course the decision about as an owner manager of a company, do I pay myself just a salary? Do I mix it between salary and dividend? Do I pay myself just a dividend? Those are the questions that need to be posed. That employment allowance, as we've said, serves to reduce only employers' Class 1 NIC and only down to 0. It does not, as we see there in that next point, it does not reduce Class 1A NIC. Okay, well, we've got our first example where we've got to do the lot. Calculate Class 1 and Class 1A NIC liabilities in respect of the employee. Now, again, if you get an objective testing question, as well you may, in terms of national insurance contributions, we keep on saying it, but read that question carefully, as regards exactly what they want you to compute. Do they say, as here very carefully, that you want both Class 1 and Class 1A NIC liabilities in respect of this employee? What you could get is calculate the national insurance contributions payable by the employee. If it was payable by the employee, that would just be the Class 1 primary contributions. Do they just ask for the Class 1 contributions payable by the employer? Or do they ask for all of the NICs payable by the employer? That would include both Class 1 employers and Class 1A. So you do have to be very, very careful about making sure that you are answering the question that has been posed and not just assuming that it is the question you think it is. Be very careful. You really don't want to be spending 3 or 4 minutes trying to get the answer to the wrong question and therefore getting nothing in that time. So read it very carefully. Right. I want you to read the information there very carefully. Have your NIC rates and allowances page open dealing with Class 1 and Class 1A, though of course that information is written above, and then we will consider how it is we go about calculating the tax charges there. So have a read with that just for a moment, please. So what do we know here about the contributions to be paid and by whom? Employee has got, let's get a pen working, £50,000 per annum is the salary paid, and got benefits. Now, in relation to those taxable benefits, car and fuel benefits, that we know is Class 1A NIC, and it's at 13.8%. So that should be a fairly straightforward exercise to get the Class 1A NIC. Remember, that is payable by the employer. So far as Class 1 is concerned, then there is both the primary contribution paid by the employee and the one paid by the employer, sometimes referred to as the secondary contributions there. Primary, payable by employee, secondary, payable by the employer. Now that's based on your salary of £50,000 per annum. Now what we know is that up to £8,060 there is nothing to pay. So that's at 0%. And whether you go above that or not, the first £8,060 will have no NIC chargeable on it. It's only when you go above that. Now this salary is £50,000. What we have got, of course, for the employee is an upper limit of £43,000. So far as the employee is concerned, what will we have? As we've gone above 43,000, the whole band between 43,000 and where it started, £8,060, that is all going to be taxed at the main rate of 12% there. That's 12%. Above 43,000, here up to the level of the salary 50,000, so 50 minus 43,000, that benefits from the lower employee rate of 2%. So if we do those calculations, that will tell you how much is payable by the employee in respect of the employee's employment income. What we've also got to do is to establish what's payable by the employer in respect of the employee's income. We already know those benefits at 13.8% will be the extent of the Class 1A, but the Class 1, easier calculation. Below the lower threshold there is nothing to pay at all, and there is no upper limit. So what's the employee being paid? £50,000. What was the threshold below which you do not pay? £8,112, and all of that is at the single rate of 13.8%. So I'll leave you, therefore, to do those calculations, but also remember, though we can't here factor it in, we're just told about an employee of Riga Limited, of course, from the total of all the Class 1 employers' NICs. From that total, we would deduct the employment allowance of £3,000. So again, be very careful. If they tell you here about all of the employees, maybe there's 2 employees and we've got to work out what the overall costs are in terms of NICs, then you would be able to deduct from the Class 1 employers what that employment allowance would be, the £3,000. Obviously, it's not specifically deductible in relation to one employee there. Okay, so Class 1 and Class 1A contributions we should now be able to deal with, whether we're dealing with the employee or the employer. But again, be forewarned, read the question very, very carefully as regards what really is the requirement. Oh, by the way, you therefore can check through with the model answer, put your numbers through your calculator, make sure you're happy with those, check with the model answer in the back there in the example answers. But that's just use of calculator. Right. Now we said that it is a tax on workers. Not everybody is an employee, some people are self-employed. Now to begin with, it looks like bad news for the self-employed, because we've got 2 classes of national insurance contributions payable. We've got what will be seen to be not a particularly worrisome figure for Class 2 contributions, and what is the main NIC payable by the self-employed, Class 4. So we'll have seen Class 1, Class 1A, Class 2 and Class 4. There is a Class 3, but there's nothing for us to worry about. Class 3 is where voluntary contributions are paid by the individual there. You might think, who would voluntarily pay tax? But the idea, of course, as to why you might do it is to preserve your right to certain state benefits. Not the least here in terms of your state pension. That will depend on for how many years over your working life you have been paying national insurance contributions. So as not to create a gap in that, you may indeed make voluntary contributions if you're looking to maintain your right to that specific state benefit. But what are we going to do in terms of calculation? Now, very easy on Class 2. The self-employed, it's a flat rate contribution of £2.80 per week. So if the individual has been in self-employment for the entire tax year and they ask for the Class 2, it's £2.80 times 52 weeks for you to be able to establish that figure. Again, like with Class 1, only from the 16th birthday. There's not going to be too many self-employed, no doubt, below 16. And it goes up until they reach pensionable age, when the tax-adjusted profit assessed for the tax year then, right, I think we should have had a full stop there, but when the tax-adjusted trading profit assessed for a tax year exceed a small profits rate, that's that threshold of 5965. Right? That's when it becomes payable. If the individual has a tax-adjusted trading profit, again, less than that, then on that basis, there would be nothing to pay. So it only kicks in when you go over that limit there. The way in which we pay this So far as Class 1 NICs were concerned, everything was done by the employer. Through the pay-as-you-earn system, they deducted at source from the employee's salary any Class 1 employee NICs, deducted at source, and then would pay it over to HMRC along with their own employer's NIC, and along also with any income tax that was deducted in relation to their employees' income. Similar here, in as much as Class 2 NIC is now payable under self-assessment, but will be due on the 31st of January following the tax year. So for 16-17, it will be due on the 31st of January 18, along with the Class 4 NIC below. So whereas the employer is doing this on a weekly or monthly basis throughout the tax year, so far as the self-employed is concerned or are concerned, the Class 2, not a huge amount as we know, due on the 31st of January 2018, and due along with, because that is also when the Class 4 NIC will be payable as well. Though as we'll see when we look at the administration of personal taxes, specifically income tax in Chapter 15, we'll see that the self-employed won't just end up paying their total taxes at one date, the normal due date being the 31st of January following the end of the tax year. If you are self-employed, then in relation to your income tax on your trading profits, in relation to your Class 4 NIC, which we'll see in a moment, is also based on your adjusted trading profits, that those amounts of tax will primarily be collected through two payments on account. One in the tax year, the 31st of January in the tax year, and then a second one the following 31st of July. How that system works, however, that awaits us in Chapter 15. All we need to know here, Class 2 contributions, £2.80 a week, that figure again given on your rates and allowances. Check that the individual has been trading for the whole tax year, it's then 52 weeks thereof. If you start or finish, then however many weeks up to the date of cessation. But the main contribution payable in terms of the tax charges is Class 4. Class 4, again based on the adjusted trading profits for the tax year. The rate of Class 4 is 9%. So an advantage here in relation to being self-employed as compared to being an employee. The rate there is just 9%. Though again, you don't get all the benefits that an employee would get from the state system, but it is a lower figure. And is payable on your trading income assessment between, well, recognise these. Again, you've got a lower limit of 8,060 and an upper limit of 43,000. So between 8,061 and 43,000. So nothing payable on the first £8,060, just as was the case with Class 1, and then it's 9% rather than 12% between that lower threshold and the upper limit. Go above the upper limit of 43,000, and just like with employees, it's a rate of 2% once we go above 43,000 with our tax-adjusted trading profit. Pretty usual, contributions beginning if the employee is 16 at the start of the relevant tax year, but contributions cease when the taxpayer reaches pensionable age at the start of the relevant tax year. Okay, let's do some calculations. Jerome, a trader, has got a trading profit of £50,000 for 2016-17 tax year. And what have we got to do? Well, we have got to calculate the Class 4 and Class 2. Now again, be very careful. Do they just ask for Class 4? They won't ever, I think, just ask for Class 2. Do they ask here very clearly for both Class 4 and Class 2 NIC? Or what they could do is ask you to work out all the total national insurance contributions payable by the trader for a particular tax year. So without mentioning Class 2 and Class 4, that is what would be required. So, yet again, read the requirement very, very carefully. You don't want to be getting a figure of both Class 2 and Class 4 if they only want Class 4. And you don't want to be doing just Class 4 if they want the combination of Class 2 and Class 4. Remember, if it's an objective testing question, You're either right if it's exactly right, or you're wrong. You can't get it 3/4 right, so be very careful about reading the questions requirement. Very carefully indeed. Right, trading profit £50,000. Now, class 2, as we've said, again assuming you traded throughout the year, that will just be 52 weeks times £2.80. Class 4 NIC is the main one that we will need now to compute. It's the main tax charge. Very simple. We've gone above the lower threshold of 8,060, and of course we've gone above the upper limit of 43,000. So yet again, in between 43,000 and what was 8,060, that difference will be charged at 9%. And then from 43 up to 50,000, so 50,000 minus 43,000, that's where we drop to the lower level of 2% there. Work those calculations, again, then look at the answer in the back and agree, therefore, I hope you will agree with those answers, and we've got it done. The calculations are very simple. All of the rates and allowances are given to us on our fact sheet. Your main worry here is not reading the question carefully enough so that you answer the wrong question. And on that basis, you give up 2 easy marks. Don't let that happen to you. Okay, so there, therefore, are national insurance contributions. As we said, what should be a quick and easy exercise, a quick and easy area for us to deal with. Again, the work for you to be able to do now, over and above what's in the course notes. You've got the Finance Act technical article, which will just, again, basically go through these are the rates, and here's a couple of examples to illustrate. And also you've got practice question 21 to have a go at as well. Well, we now change tack quite dramatically because we move from taxing income in all its various forms, or as here just employment, income and trading profit for workers, to look at capital gains for individuals. So the next 3 chapters, chapters 12, 13 and 14, will look at how it is that we compute a capital gain for an individual, how it is we will bring all of those gains and possibly losses together, again for a time period which is the tax year, 6th of April to following, 6th of April to following 5th of April there, and how, having got the amount of net gains for the year, we compute the taxable gain. So, like with income tax, what was the assessable income? We deducted a personal allowance to get a taxable income, and then we calculated the income tax liability. What we will be doing here is to compute individual gains on disposals of assets, individual losses, net out those gains and losses to get the net gain for the tax year. All of which, don't worry, we'll see in that next chapter. This is just a flavour of that for you to know what's coming. With capital gains tax, just like it was with income tax, there is a level of tax-free gains. The level of tax-free income, it was known as the personal allowance. The level of tax-free gains is known as our annual exempt amount. That will be deducted, and we'll now have taxable gains rather than taxable income, which we had in income tax. Then we'll need to see how to tax it. Now, with income tax, your problem was the different types of income and the different tax rates that may be applicable in terms of are you basic, are you higher, are you additional rate taxpayer. So there's a variety of rates. Now, on some of the same reasons and some new ones, there's a variety of tax rates that may be applicable to those gains in CGT. A lot will depend again based on your income tax computation for the tax year. Are you or are you not a higher rate taxpayer, or are you just a basic rate taxpayer? And then, rather than the different types of income as it was with income tax, it'll now be different types of gain, different types of asset. What assets have generated these gains? Because depending on the answer to that, different tax rates again may be applicable. And that's our main focus of attention, and looking at specific assets and specific problems that attach to that. in terms of Chapter 12 and Chapter 13. Chapter 13 indeed deals with just one very specific asset, shares in companies when they are sold. So a complete chapter just over one particular asset and how it is we compute those gains in the tax year. And Chapter 14 deals with, now this is good news in real life, not so good news for you, because there's a lot to learn here, because it's all about CGT reliefs. So if you've made a capital gain, are there any reliefs? Reliefs which at their best might exempt such a gain, or not as good, but certainly good in the short term, they might defer those gains. We will need to learn the rules, the labels that attach to all those different reliefs. And that's a challenging chapter indeed, but a most important one, because if you do go through to look at P6 Advanced Taxation, what you learn there is going to be very, very applicable at that level as well. But there's time enough for that. An important area, and no doubt one that will be tested within your examination system at F6. Okay, look forward therefore to introducing to you in the next chapter capital gains tax.